So we're definitely here to support you and help grow your business. So just excited to be part of your training today and kind of share a little bit about our success, which is your success, so that we can go through the numbers and also share with you what we're doing to improve and get better. All right. So I am going to share my screen, Leo, if that's okay, if it lets me do it. Can you, let me see here, so I can do it. Yeah, I can. There we go. All right. Can you see it? It's good?
Yes, it is.
All right.
Very clear. Thank you.
Excellent. Okay. Very good. So
but we have double screen, so maybe the setting.
Oh, hold on. Yeah, let me take that off. Let me see if this helps. Let me exit here. Is that better?
That's perfect. Thank you. Better.
Okay, good. Yeah, I have a couple screens in my computer here, so that's why it happened. But yeah, thank you for that, Leo. All right. So first and foremost, I want to say thank you for all your business that you send to us. It really is amazing what you are doing out in the field. I've been selling insurance, or been in the insurance industry since 2007, so about 15 years in the industry now, and I've seen a lot. I've been a broker, I've been an agency owner, I've had agents, I've had agencies work for me. I've worked across, with a lot of different carriers. But what Freedom Equity Group is doing right now, it is unlike anything I've ever seen. First and foremost, what you're doing is you're changing the industry. And by that, I mean, you're bringing new people to insurance, okay? Traditional insurance agents are a different breed. They just switch from company to company. They trying to, find ways to grow their business, or trying to find ways to grow revenue, but they're not recruiting and bringing new people to the business. So first and foremost, that is an amazing job that Leo, you're doing with your team, and Freedom Equity Group in general is doing that, which is just amazing. So thank you for that, because our world is changing. Here in America, it's changing demographics. It's changing the way that, with the big immigrant communities are coming in. I myself am Latino. My family's from Puerto Rico, and then first generation. So it's, we're starting to learn more about how to invest our money, how to protect our money, and life insurance is one of those things. And it's just amazing what you guys are doing. So thank you for that. It really is changing the way we do things. And with that, you're also generating some amazing revenues. The partnership that we have with Freedom Equity Group is unlike anything I've ever seen. I'm sure you've all heard of ESP. That is changing the way that we are partnering with our important agencies like yourself. The fact that we own 30% of Freedom Equity Group, and we paid out that money and you received that money, and the fact now that we're going to buy another 30% in 2024 is just amazing. That's really unique in the industry. I've never seen anything happen like that before. So the fact that you're part of such a unique experience in what Freedom Equity Group is doing with Fidelity and Guaranty is really cool. And because of our relationship that we have with you, we've created proprietary products. Okay, we have about 40,000, approaching 50,000 agents that we support across all of our distributions. But only about 10% of those, FEG being one of these organizations, has access to our Freedom and Gold products, which is the proprietary exclusive products I have here on the first slide. So what you are offering to your clients, only 10% of the agents have access to this product. Everybody else has other products that we sell. And to be honest, the products that you have are superior to what other agents have out there. So know that you are selling some amazing solutions and offering some great products to your clients. And because of that, what we've done is we're trying to streamline our processes to support you in a much better way. Leo kind of mentioned early on in the beginning that, we've had some struggles recently. And that's honestly due to your success. You've put in so much business. You've sent in so many applications, it kind of caught us off guard. We didn't have the staff to get us to support that. So just to kind of give you a little backstory so you understand where we're at, where we were, and now what we're doing about it. Early this year, we had a huge influx of volume thanks to your success in getting a lot of clients on board. So we were a little bit understaffed on our underwriting team. So what we did immediately after we found out that we were a little behind, we were able to hire and add 5 new underwriters to our team within a month or two of us realizing the problem. So we reacted pretty quickly within that. But then what happened was, once our underwriters got on staff and trained, they started approving a lot of cases. And then our case management team, our operations team that handles all those cases, they were getting put behind because the volume of policies being approved was too much for them to handle and get them issued and paid. So what we've done about that is we've hired 12 new case managers over the last 3 weeks. All right. So we just hired them. So we're still in the training process, but the goal is once they're up and ready to handle the caseloads, that should help alleviate some of the backlog that we're seeing. So now we can get back to standard, getting underwriters to approve in, 1 to 2 days, get our case managers to approve in 1 to 2, get policies issued in 1 to 2 days. So within a week's time, it should get us to where we need to be, where we were prior to these issues. So that's our ultimate goal. We want to be able to create a great experience for you and for the clients. And right now we're fully aware that we're not meeting that, but we're taking active steps to make sure that we can accomplish that and help you succeed. Because if you can write business and make it easy for your clients, the better off everybody will be. Your clients will be happy, you'll be happy, and we will be happy. So that is our ultimate goal, and we're taking active steps to do that. And also recently I've heard that we were just told that we're expanding our sales team as well to help support you on the internal side as well. So all these things are happening for the better. Like Leo mentioned, it's a good problem to have. You've done such a great job producing lots of business, and now we have to adjust, but I'm happy to do that. I'd rather that than business going down and the business not coming in. So I appreciate everything you're doing and know that we are taking active steps to help support you. So that's the dedicated staff. That's the kind of our ability to adapt and change to make sure that we're doing our best to support you. And another thing, which we'll get to in a little bit, is just talking about our indexes. I feel that, like I said, I come from the insurance world. I've seen other carriers. I've sold other products, especially in the IUL markets. So what we offer here at F&G is very unique in our solutions, which I'll get to here in a minute, so I can kind of go through those details. All right. So talking about success, you are shattering records every single month. I get a report on a weekly basis that shows me the production that FEG is doing, and it is just going straight up. That line of sales is nonstop, increasing so much that you can see here over the last couple of years, you have grown exponentially. Back in 2018, FEG with just F&G, right? I don't know what other production you guys do with other carriers, but just with us alone, you're doing about $9 million with us in 2018. 2019 hit, we got $14 million. Pandemic came around and you grew that to $20 million. And then finally, in 2021, you hit $28 million with just us. That is just amazing, astronomical growth. And right now, based on numbers that we're seeing, Freedom Equity Group is on pace to hit $38 million in sales just with F&G alone. So you guys are doing an amazing job. Keep doing what you're doing because people need our help. Right now, I'm sure you watch the news. You see what's happening in the economy. We are in a recession. The markets are not doing really good. People are losing lots of money in their 401ks, losing money in their IRAs, losing money in their 403bs, their TSPs, 47s, whatever you want to call it. Anything invested in the stock market is losing money right now, and it's just going down and down and down. But we don't sell products that lose money, right? We sell IULs, Indexed Universal Life. We sell indexed annuities, and these products have a floor, which means you never lose. So anybody who owns an IUL right now has lost nothing. Anybody who owns an indexed annuity has lost nothing. And that's the beauty of what we offer. Right now, zero is our hero. Our clients are happy because they have not lost any money. And the best thing about indexing is once the market's reset and it starts going back up again, we ride that wave all the way back up again, right? And just generate more and more return. That's the beauty of what we have to offer here. And that's all that we sell, is just solutions that are in the index category. And with that, we've been able to grow as a company. You know, your success has allowed us to be successful. Right now, across all insurance companies that sell IULs, which is about over 120, we are ranked number 8 across all those companies in IUL sales. And then if we only look at the companies that sell through independent channels, which is what you do, you're independent agents, you're not a captive agent that works for an insurance company, you're a truly independent agent, we rank number 6 across that category. But what's mind-blowing to me is the fact that we are 8 and 6 across those distributions, but yet we're number 3 in case count. What does that mean? That means that you're selling a lot more policies than most anybody else. Top 3. We're selling a lot of policies that's allowing us to protect a lot more lives, okay? Despite the fact that we're 8 and 6. But I strongly believe that by the end of this year, if we continue growing the way we're growing, we're gonna be a top 5 IUL carrier. And I don't see why we couldn't be number 1 the next couple of years based on our growth and projections because of what you're doing. So our success is because of your success. So thank you for that. So let's look at our solutions, okay? I think this is something important to talk about whenever you're talking to your clients as to why F&G is a great company to have in your portfolio when it comes to IULs. Well, first and foremost, we have strong performance. Ever since I've known F&G, which has been for quite a while now, we've always had caps, high caps. That means that we are getting, better performance out of our product. And not only do we have high caps, we keep them high, which is a reliable cap history, as you see there. And we'll show you here in a minute what that looks like from a historical perspective, that we've maintained our caps at a high rate compared to our competitors. And we like to keep it at a high level. And the reason why we're able to do that is because we have a really strong relationship with some of our investors. So we work with an organization, you might have heard of them or maybe not, but you want to look it up, called Blackstone. Blackstone is an organization at Wall Street that has billions and billions, if not almost trillions of dollars of investments. They're a huge, huge organization, and they help us with the investments. So the fact that our relationship is super strong allows us to have high caps and reliable cap history because we have the best working for us, and we're able to generate a lot of return for our clients. So that's important, getting strong performance, because you want your IUL to actually give you returns and make money for your clients. One of the reasons why we sell IULs is not only for have protection, which is important, but also we get tax-free income, right? These are designed for accumulation. And one of the things that's important to note is whenever you sell these products, yes, it's about today and the protection you get and the growth opportunity, but it really is, at the end of the day, how much you get to keep, okay? And with our product, you get to keep a lot, because the way we're able to access the money through IULs is through loans, right? A loan allows you to get tax-free income. If you get distributions, that's when you pay taxes. With us, we're able to access the funds or the cash values via loans. But to get a loan, there's always an interest rate, okay? And again, anybody who's watched the news recently has seen interest rates are going sky high. It's getting ridiculous. I mean, I know like the mortgage rates have doubled. Car loans have doubled. It's just amazing what the cost is to borrow money. Well, with our IULs, we have a cap on what that loan interest rate is going to be. And that cap is 5% or 5.5, depending on the product. And that's contractually guaranteed. Now, not that big of a deal today because you're not accessing the money. But in 20, 30 years from now, when your client wants to take money out and the cap is set at 5%, and let's just say interest rates in 20, 30 years are at 8 or 9 or 10%, you're guaranteed to have only 5% interest rate to borrow your money against your IUL. That'll beat any product out in the marketplace. So that is a huge feature that you need to focus on. Granted, it's long term, but heck, that's why we have these products. It's the long term, not for the short term. In addition to that, with our IULs, we have some proprietary indexes. We partner with an organization called Barclays. They've been around for 325 years. That's right, 325 years they've been in the banking business. We have a partnership with them, and they created a product for us, an index that has no caps, no spreads, and gives you 190% participation within that index. So the opportunity to grow money within our indexing strategies is amazing. And we'll get a little bit more detail here in a minute and show you what that looks like. And then finally, which is I think another amazing feature of our IUL is the fact that it has living benefits. All right. This is something that's relatively new. I'd say the last 10, 15, maybe 20 years, companies have started adding these benefit riders. They've always been riders you have to pay for, but now they're actually being included as part of the policy. There's no additional fee to have them included. And this brings life insurance to the new age, right? Now you don't have to die to access the funds. If you get a critical, chronic, or terminal illness, you have the ability to access the funds while you're alive and help pay for those medical bills, right? Health insurance only covers so much. Who pays for the flights to see the doctor that's in a different state? You do. Who pays for the hotel for your spouse while you're in the hospital? You do. Who pays for the groceries? You do. Who pays for the mortgage while you're away, while you're getting treatments? You do. Now, if you can't work, or if your spouse can't work because they're sick or ill, how do you do it? You have a living benefit. That's how. Having a life insurance policy that protects you while you're alive, for life, not for death. But if you do happen to pass away, which we're all going to die at some point, let's be honest, that's the reality of life, you have life insurance as well. So it's this tool that gives us so many different options within one solution. It can't be beat. And personally, I own 4. That's how much I believe in this product. I have one, my wife has one, my 2 kids have one, okay? So it's part of our portfolio. And it should be part of yours as well. It should be part of everybody's. So it's our job to educate and teach our clients how money works. And this is an amazing solution to have in your portfolio. So look at those options, okay? We talked about historical performance of some of our solutions here. Now this one here talks about our cap rates. You can see here, back in 2012, our cap for our product was 12%. It went up over time as the economy does well. You know, we want to increase as well to compensate our clients for having our products. And you can see they've grown up to 14%. And yes, tough times come around and we have to unfortunately, lower our caps. But the fact that our cap rate in 2021, which is still today true, at 2022 is 12%, same that it was almost a decade ago, okay? I've seen other carriers drop their caps to 10, 9, 8.5%, 8%, right? Because they're going through tough times. But we try to keep ours as high as possible within reason. Another thing to note is these rates are for not only for new policies, but also for existing policies. You'll see some other carriers out there wanting to change the interest or the cap rates for their existing block of business versus their new block of business. That's not us. We keep it the same, but 12%, 12% for everybody, not for the new or the existing clients. I think that's important to note as well. For our Freedom product here, you'll see here, not much fluctuation on these. We kind of kept these relatively high at 15.5. Now we're at 12.5. But again, still solid performance with the S&P 500 when it comes to those cap rates. So it said we kept it relatively high. So here we kind of go into a little more detail of our product. I'm not going to go into too much information because it's a lot of information here, but the point is that we have options within our indexing strategies. Almost every carrier out there you're going to talk to, you're going to see, is going to offer the S&P 500, right? That's just your standard point-to-point, strategy that does well. It typically has decent caps, as you just saw with ours. It's the go-to for most people. Average return, about 9.5% or 9.8% since it, it's been implemented. But what we've done is we've added some different ones. We've added our Barclays Trailblazer, right? Like I mentioned, it's been a company that we partner with has been around for 325 years. That tracks multiple indexes and multiple types of industries. So it kind of protects you from volatility, which means products going up and down. And it just stabilizes the returns. So it kind of gives consistent returns with volatility in the marketplace. So it's a good solution to have in your portfolio. Another one we've added is our Dow Jones real estate product. So with this one here, it has 10% volatility. So it gives you more stabilization during uncertain times. This one has amazing upside potential. And you'll see here in a minute over when the markets go up, the Dow Jones real estate product goes up as well. It just provides diversification. It's only real estate, so it's not tied directly to the stock market. So it gives you some different options to provide to your clients when it comes to indexing strategies. The other one you see is the gold commodity. Now this one's only offered on the gold product. The Dow Jones, Barclays, S&P 500 is offered only in the Freedom, but we offer these and the gold in the gold product. And what's cool about the gold product is it's a hedge. A hedge is something to help diversify a product, to have options for your clients. So when the markets go down, S&P 500, real estate goes down, gold actually goes up. It works in opposite of what's happening in the stock market. So right now, our gold index is performing at a high level because markets are going down. When the markets go up, gold goes down. Now, why is that? Well, gold is a commodity, it's a metal. And when people start getting scared with their investments, when it comes to stock market investments, they want somewhere to put the money that's a safe, guaranteed place. What place is that? Gold, silver, bonds, stuff that's safe. Gold is one of those solutions. So when we add this to the portfolio, it really balances out the returns, which we'll look at here in a minute as well. And then finally, not a big of a deal, but I think it's important to note our fixed account right now is around 4.75. That's a pretty good return for a fixed account, way higher than any type of CD that's out there that people put money in the banks and stuff like that, or savings account. So really good solution to have as well, just to kind of get a little bit of guarantee. No matter what the markets are doing, you'll get that fixed account. So that's a good solution to kind of add a little bit of your money into that strategy if you choose. So here I want to show you the S&P performance. Okay, this is our point-to-point strategy comparing 2020 to 2021. The column I'm going to look at is the far right, where you see the index return with the cap. You can see here from January 2020 to January 2021, those really good gains. The product capped out at 13.5% for this strategy. And you can see across the board all the way from January to December, it was a great year to be in the stock market, great year to have S&P 500 as your strategy. So it capped out at the max capacity, 13.5 and 13%. Okay, so you can see here how well that product performed, or that index performed. If you look at the real estate strategy here, with this one, in early 2020, what happened? We had the pandemic. It started. People were scared. What's going to happen to real estate? I can't pay my mortgage. I need to go into foreclosure or forbearance. Investors like, well, shoot, are people actually going to pay their bills? Are we going to have a housing crisis? We did not have a housing crisis. We had a housing boom. So being in this strategy early on, yeah, we hit the bottom, 25 basis points, 0.25%, 0.25%. We lost in that index. But what happened after that? We realized, hey, wait, I get to work from home. I can still make money. Heck, I'm tired of living in the city. I want to move out to the suburbs and have a bigger house so I can work from home. I want to buy a new home. I'm willing to pay $10,000 over asking, $50,000 over asking, $100,000 over asking. The housing market just boomed. You can see in this index what happened. Since there's no cap on this, look at that. 12, 14, 16, far right columns I'm referring to. 18%, 18, 18, 18, 18, 19.4% return on the Dow Jones index. That's amazing. Now, if we look at the gold, opposite happened. Early year of 2020, it was a pandemic. People were not investing. The markets were losing a little bit. Housing crisis was in place before it boomed. What happened to the gold product? Almost hit its peak. Cap there is 16%. Look at that. We got 16% the first month, 14.9, 15, and then what happened? Everybody's like, wait, I think we'll be okay. Market started going back up again. Dow Jones real estate started going back up again. So people said, you know what? I don't need gold anymore. I want to go put money back in the stock market. So what happened to this index? It hit the bottom. 2.2, 6.8, 9, 1, 0.25, 0.25, 0.25, 0.25, 0.25. So it works in opposite of what's happening in the stock market, S&P 500, or the real estate market. And I'll show you here in a minute why that's good to have in your portfolio. Think of our Barclays, kind of our steady type solution, right? It doesn't have much volatility. If it goes up, but not too much. It goes down, it go down by too much. There's some protection there, good participation. So again, early 2020, markets were not doing so good. People were scared, didn't perform. As it got better throughout the year, it increased. The point of me showing you this is that obviously we have some great performance in our product, but most importantly, what's to note is you want to diversify these indexes for your clients. You want to give them options. Because if they only have one index in their portfolio, it could perform that year or it could not. You're taking a risk. But if you, in this example we have here, if you equally spread out the indexes, assuming we do 25% S&P 500, 25% in the Dow Jones Real Estate Index, 25% in Barclays, and 25% in gold, you can spread that risk around. So yes, S&P peaked at 13% in January, and then Dow Jones hit the bottom at 25 basis points, Barclays at 25 basis points, but gold hit 16. Average there was 7.4 on the far right, the policy credit. February, same situation, 7.2. March, things started getting a little better. You can see Dow Jones industry went up to 10 right here. So now the average is higher, 9.9. The point is, by having all of these strategies in your portfolio, you're doing your client a great service because you're balancing out the risk. One might not do well, but one might do really well. Average of that, you're looking at 7, 9, 10%, depending on the month. And that's the beauty of having these options. This is for the gold solution. Now, if we look at the Freedom product, which excludes the gold strategy, so not only gives us the S&P 500, the Dow Jones, and the Barclays, you can see performance there. Early on in the year, everybody struggled, but as the year got better, we got better and better performance out of it if you average it out. So this is assuming like a 33% into each strategy is the average there. Now, I don't know about you, but seeing 8, 9, 10, 12% in my portfolio is amazing. Given that you don't lose. Remember, there's a floor. The floor is 0. Well, for us, it's actually 0.25%. You always get something. And if you add a little bit of the fixed account here as well, it gives you a little bit more potential return. Important thing is to use the strategies for your clients. Share with them the options, show them that if they diversify and use a little bit of everything, they protect themselves from the big swing, not too many highs, not too many lows, just a good, even 6, 7, 8, 9, 10% return. You can give them that consistently. And the fact that this accumulation comes out tax-free, you're going to be a winner with your clients. Now, living benefits. Talk a little bit about those. Huge when it comes to having this in your portfolio in our product line. I mean, I can't tell you how big this is in this day and age because medical bills are just going up and up and up. One of the main reasons people go bankrupt is due to medical debt. And I know that Freedom Equity Group does a great job of recruiting some nurses into the business. So maybe some of you are, maybe some of you might know some people in that medical field. They can attest that getting sick is not cheap. It is very, very expensive, especially when it comes to a critical illness, terminal illness, or a chronic illness. That will deplete your savings account extremely fast. But you have a solution that gives you some extra income to protect against that. It gives you peace of mind. With our solutions, on a critical illness perspective, we accelerate up to 100% death benefit, and the max is $1 million. What does that mean? That means you have a $200,000 policy, you only get up to $200,000. You have a $500,000 policy, you get up to $500,000. You have a $2 million policy, well, the max is only $1 million, so you only get up to $1 million. That's our cap when it comes to the critical illness. But what does that protect us from? Well, you have to qualify for it, obviously. It's not any critical illness. It has to meet our qualifications. So it has to be either heart attack, stroke, organ transplant, paralysis, ALS, arterial aneurysms, central nervous system tumors, major burns, diagnosis of invasive cancer, or renal failure, kidney failure. The big three here, heart attack, stroke, and cancer. Those are the main ones that here in America tend to really hurt us financially and are extremely common. So to have that protection in place with critical illness is just amazing. In addition to that, we also have terminal illness rider. That's also up to 100% of death benefits if the insured is diagnosed with terminal illness and the life expectancy is 24 months or less. Not all carriers offer 24 months or less. Some do 12. We do 24. The only state that doesn't allow us to do 24 months is Florida. That is not an F&G thing. That is a state of Florida insurance issue that they've determined that's what they want to require. So we said, well, if those are your rules, those are your rules. We can't change that. So that rider is up to $1 million, 24 months, 49 out of 50 states. And then finally, chronic illness. This one is if you can't perform 2 out of 6 activities of daily living, or if you're have a severe cognitive impairment, you qualify. We accelerate up to 25% of death benefit on an annual basis. So 25% death benefit up to 4 times. And you have to qualify every 12 months with a maximum of $1 million again. So all of our living benefits have $1 million cap for critical, terminal, and chronic illness. These riders are available only if you get a health rating of table 4 or above. Most clients are going to qualify for this. If not, I can't say all because some don't, but the majority will, because most end up being standard or preferred. But for any reason you get one client that's table 5 or lower, unfortunately, we have to take away those riders. But I haven't really seen that happen that often because most people tend to qualify within the proper range. And the bottom note you see there is we put chronic illness available in California. Up until recently, that wasn't allowed, but we were finally get approval in the state of California. So I just want to remind you guys that now we can offer chronic illness in the state of California. So that's a really good thing. We were excited to finally get that approved. So that's a very positive step forward. Yeah, so now you have a product that not only gives you death and protection in case there's unforeseen death in the family, but if you don't die, you get sick, now you have living benefits to protect you against those catastrophic type illnesses that just wipe out your bank accounts. But if you don't die, you don't get sick, now you have access to your money via tax-free loans. And you can get a potential stream of income at retirement with having this solution. It's a Swiss Army knife of life insurance. You have all these options that are built into this product. It's one of the best solutions in the marketplace, in my perspective. You don't have an IUL in your portfolio, you're missing out. Right? So from an operations perspective, I kind of talked a little about early on, I wanted to address the issues that we've had and tell you about the solutions that we had going on. Hence, I already talked a little about the underwriting staffing, so that's been addressed. But, we've implemented DocuSign. There's documents that we will accept from a DocuSign perspective, but I'll be honest again, there's still some documents out there that require wet signatures. Those typically tend to be documents that other companies require. If we have like 1035 exchanges, or there's other type of documentation that the states wants to have, they still want to accept that type of stuff. But for the most part, anything that's to do with the F&G, we will accept a DocuSign. So please use that. One thing to note is when you're doing that and you use a DocuSign, the actual product DocuSign, make sure you submit a certificate of completion, okay? So if you want to write that down somewhere, certificate of completion, that shows proof that the document was electronically signed. It kind of gives a little statement of saying if it was sent on this day at this time, it was e-signed by this person at this time, kind of a timestamp of the product. And that just helps us verify everything to make sure it was truly electronically signed. So it's called certificate of completion. And that'll help us just verify the electronic signatures. So please include that whenever you send a DocuSign. And I've seen that come across my desk a couple times, and it makes it easier for us to process those electronic signatures. Something that we've implemented as well is we noticed with Freedom Equity Group, we tend to have quite a bit of juvenile policies. Anybody under 17 is considered juvenile. I'd say about 20 to 25% of our business from Freedom Equity Group comes in juvenile cases. And juvenile cases can only be sold in the gold product. The gold product can be issued from age 0 to 80 versus the Freedom is 18 to 80. So all juvenile policies will be in the gold solution. So we've done a jet issue. that means is we're trying to automatically approve certain policies if they hit certain parameters. So anything under $200,000, and everything comes back clean from medical records, from just a background check, which how much issues you're going to have with a child, but we double check everything to make sure. If everything hits the parameters, it doesn't even go to underwriting. Our case managers have been given the green light to approve the cases under $200,000 that meet certain criteria for underwriting. So that's about 5 to 10% of those policies that come in that way that we can just sell immediately. And we're looking to expand that even further to kind of get stuff issued quicker and faster for you. And as Leo mentioned early on in the meeting as well, he talked about exam-free and instant approval. So we've been testing some products, or a product that is instantly approved if it meets certain parameters, to kind of see how that works, to make sure that we can offer that in future products that we launch. So to your point, Leo, in the future, that is something that we're exploring, so that whenever the idea is you submit the application, while you're doing the application, the client will sign off on the background check. So by the time you complete the application, we can run the background check, run the MIB, run prescription history, get that information back and quick enough so we can make an instant offer right then and there. And the client can either accept, or if they say, you know what, I got a standard rating, I think I'm preferred, we can switch to underwriting, right, and see what it offers. But the idea is it gets instantly approved at some point, and then if payment goes through right then and there, commissions will generate automatically. So that's the future, and we've been testing a little bit with a product with a couple of smaller brokers out there to see how that works. And we're getting enough. If we get enough positive information from that, that's something we're looking to roll out in the future to make your life easier and make the client's life easier. And the way we're going to do that is with that last bullet point there, is switching to LexisNexis for a credit risk-based score. Whoa, what does that mean? Information about you, your clients, is on the internet. We put it out there with our medical records, with our prescription histories, with our social media, with our purchasing habits, with our credit card companies, with our flight histories, our purchase history. Everything is digital in this day and age. So what this company's done is it gathers all that information and it gives us a credit risk score, a life classifier score, and helps determine whether or not you are, worthy enough to receive that preferred rating, or do we go with the standard rating? Okay, and it looks at everything, right? Are you buying too many McDonald's burgers, or are you buying salads every day? Are you buying that pack of cereals every once in a while, but still are a non-smoker? Do you have speeding tickets? Do you not wear a seatbelt when you drive your car? Are you getting prescription medications? Even though there might be a little bit over-the-counter stuff, there might be a little prescribed. And like, oh, what's going on here? We look at everything, and that helps us make a determination, okay? And by doing that, it allows us to start exploring that instant approval. If we can get enough information that helps us determine a health rating and a score, and it meets our parameters, why not automatically approve it? Why go any deeper? Now, if there's some red flags that pop up, then okay, that's why we have underwriters. Take a look and see and really understand what's going on. So hopefully by switching over to this solution here, we'll be able to get to the point where we can do instant approvals. That is the ultimate goal for us and for you as agents and for your clients. So in summary, why F&G and why our IUL? Well, first and foremost, we have the high caps, like we talked about. Reliable cap history, which drives performance. You want to have a product that generates returns, not just looks fancy on illustration, but actually delivers. As you saw those information I showed you, those were true returns. That's what we paid out on that performance at 13.5 caps on the S&P 500, 16% of the gold when it hit the max. So reliable cap history. We have our indexes for good participation rates. You really can get that performance in our product. That loan feature, again, it sounds silly, and I know I talked a lot about it, but it is so important, especially now in the interest rate environment that we're in. To have that contractual guaranteed rate at a cap is huge. Huge features 20, 30 years down the line. Living benefits. We just talked about those. All our products have living benefits. That's what all products need to have, and we have it. We have exam for underwriting, and our goal is to get the instant approval at some point. We want to make the experience as best as possible for you and for your clients, and then constantly improving. Like I said, we've had some hiccups, we've had some bumps in the road recently. We own that, but we're taking active steps, and we're reacting fairly quickly to address those concerns and hired staff. And if we need to hire some more, we will. And that's the beauty of what I love about F&G is we're willing to make those adjustments and react quickly. And the fact that even though we're based out of Iowa, we are now a national company where we're able to recruit talent from across the United States. We have embraced remote work. So we have, I myself am in Texas, even though our offices are in Dallas. My boss is in Florida. Our internal sales team, half work in Des Moines, the other half are outside. One lady works in Ohio, another one works in Florida. The rest are in Iowa. My other team members that work with me are spread across the country from a sales perspective, right? So that has allowed us to find the best talent and recruit quickly and easier than just only looking in our little hometown of Des Moines, Iowa. So it's allowed us to maneuver and react and hopefully, create a great experience for you and the clients. And I have to show you these things because I'm required to. Disclosures, it's required. And that's us. That's F&G. So Leo, I'll turn it back to you. I see we have some chat. I don't know if there's any questions there, but I'm open to answer a couple of questions here, but I also want to respect your time.
Thank you very much. That's a very wonderful presentation regarding Fidelity and Guaranty. And I believe so that we will be able to move forward. Are you prepared now for the running of a very great illustration that we can share to our participants, because a lot of them are brand new? So maybe they want to learn on how to run a very good illustration, hypothetical illustration that we can use for our clients. So take it away, please.
Yes.
So while waiting for the screen to pop up, for the shared screen to pop up, I want to recognize everyone. This is an amazing first time that we have a great number of participants. And I'm hoping that we will soon have more trainings similar like this, maybe even better, maybe even deeper, detailed trainings of every products that we can offer. I know that a lot of us are hungry on how to, market our primary product, which is Fidelity and Guaranty, definitely, because remember, Fidelity and Guaranty own our marketing company, FEG, 25%. Oh, is that 25? No, 30%, if I'm not mistaken.
30%,
so
30%, yeah.
So that's why we are blessed, and we are very thankful that we partnered with one of the greatest company ever in town right now. And thank you very much, because we have a ever patient Mr. Rodolfo Siera, who keeps on answering my bitchy questions sometimes because I'm very much eager to to learn more about our products and about the underwriting processes and about of course the commission that is coming up. Right. So those are some of the issues that is going on right now. I know that you have a lot of concerns about that for the meantime, but before we move forward, here we go. I give back again to our speaker, Rodolfo Siera, for a very good example of an illustration. So it's a hypothetical illustration. So take it away. Thank you very much,
yes, sir.
Rodolfo.
Absolutely. Yes, thank you. Thank you. All right, so here I'm showing you what you will see when you log into our back office, which we call Sales Link, okay? When you log in, this is what you'll see. There's a couple locations to find illustration software. I like the Sales Tools section down here. It says Illustrations. You can click on that, or you can go up here to Sales Tools to click Illustrations. It's the same thing. I just think it's easier because it's already right here in front of you. So click on Illustrations, and that opens up a screen here. And you can start a new case, or you can view your existing cases, or download the software. I 100% encourage you to do the online, because that is updated every single day. If you download, you have to update it all the time. so not worth your time in my opinion, but it's up to you. I always go online because it's the most up-to-date information. So start a new case. And it opens up the information here. So you can start a new case here. And then you enter information about the client, okay? So let's just do a 40-year-old female. Scroll down here, you pick the state, do California, we do IUL, Universal Life, we find available products, and let's do our Freedom. You can choose either Gold or the Executives, but Freedom is a good one. That's the max accumulation product for adults. So you go here, you can type in their email so you can get confirmation. You can select an underwriting class. Here's my perspective on this. As an agent, I always quoted a standard non-tobacco rating, assuming they were non-tobacco. If they're tobacco, obviously do tobacco. But I always like to quote standard so that you under-promise and hopefully over-deliver, okay? The last thing you want to do is quote a preferred rating and somebody comes back standard. And then all of a sudden the premium goes up, or they have to lower the face amount to adjust for the new premium payments, okay? Because the way we underwrite is no matter what health rating you put on there, we always assume somebody's preferred. And if they meet that criteria, they get preferred rating. But if something comes up in the records or in the credit history or the MIB or the prescriptions, then we start taking away points until, okay, now they've been dinged a couple of times, now they're at a standard rate. It's easier to go back to your client and say, you know what, Mr. and Mrs. Client, I quoted you standard non-tobacco, but congratulations, you got preferred. That's a lot easier conversation than saying, I quoted you preferred, and now you came back standard, your rate has gone up, okay? So that's my perspective when you come to running these quotes for your clients. And from a processing perspective, if you quote something preferred and it comes back standard, you get other than applied for. That's called OTAF in our world, other than applied for. And then you have to sign a new amendment document, you have to sign other paperwork, and it just slows and delays the commission process, slows down the operations process, because now we're waiting to get more signatures and more paperwork. So from my perspective, to eliminate that, I recommend quoting standard non-tobacco and hope for preferred. Now, will there be an opportunity, will there be a challenge where maybe somebody comes back non-standard? Yeah, that happens sometimes. Table 2, table 3. But from my perspective, I've seen a lot less delays in processing if you quote standard and hopefully get a preferred. So that's what I recommend. So let's quote standard. That was a long-winded answer, but I want to give you that information. If you want underwriting guidelines, it's right here. You click on that, opens up a PDF file and gives you some details of underwriting. So I won't do that today, but click on that if you want to learn more about our underwriting guidelines, so you make sure you're quoting properly. And then now we go to solve. So one place you're going to go is this section right in the middle called solve, solve for. Now you're going to click on this box. It's going to open up a lot of options. We're going to keep it simple today, Leo, okay? I'm going to show you the one that 90% of our agents use, okay? Which is the max accumulation and income strategy. The first one that's right here. There's a reason why it's first, because that's the one everybody uses, okay? A lot of options to choose from. We can do a separate training on that, but today let's just focus on max accumulation income, because that is what you can do the majority of the time. What that's going to do is it's going to maximize this policy to really drive performance and get accumulation and income from this product. Okay, so we click on that. It's going to open up a new window. Okay, and now we have to enter the parameters. Right, so we have a 40-year-old female is what we chose here. What are we going to solve for? Okay, well, let's just say our client tells us, you know what, I can pay. I mean, Leo, what's the standard premium in your world? $300 a month? Is that average?
Yeah, $300 a month is standard. Yeah, average.
Okay, so it's $300 a month. Okay. So what we want to try to solve for is we're going to solve for face amount, okay? Because we know what the premium is going to be, okay? So you change the mode here to monthly, and I'm going to say I want to pay $300 a month. You click here. Just that, okay? Put your monthly rate, okay? Don't worry about the numbers here. Just do $300 a month. You press OK, okay? And now you're going to say, what age do I want to pay those premiums? So we have a 40-year-old female. Let's say she pays to what, 65? Is that normal?
65, retirement age.
Retirement age. Okay. So we go here to pay premium to, and you'll see here a little I, which is information. If you want to put an age, you have to put the letter A in front of that number. If you put Y, it's year, which is policy year. So in this example, I want to put age 65. If I put year 65, that means it's policy year 65, which means she'll be 105 years old. We don't want that, okay? We want to have age 65. So age 65, all right? Now, from a cash value perspective, don't worry about that. I skipped this part right here. It doesn't really calculate much, so skip that middle part. And then the next thing we want to do is we want to calculate income, okay? We always want to do loans because that's how it comes out tax-free. Now you can do income mode monthly or annually. It's up to you. I like annual, kind of shows a nicer number, okay? And then we can start at age 65. So this one you don't need A because it already says start age. So you just put 65, and then you put how many years you want that income to go for. The standard is 25. Leo, what do you usually do? Do you keep it for 25 years or do you go further? So this is giving income to age 80 at this point. Is that okay?
Yes.
Okay. It depends. Some people like to put it to age 100. So you do it for, you know, what, 35 years? No, 45 years? No, 35 years, 35 years. But standard is 25. I say let's 25. Let's see what happens. Okay. You press OK. And that's it. That's all you do. What we told the software system now is we have a 40-year-old female that's going to pay $300 a month until she's 65 years old. And when she turns 65, I want to receive income for 25 years. The system will automatically calculate face amount, and it'll calculate the growth, and it'll calculate the income that's coming in the future. Do not go and change any of this information down here. Even though it says 150, don't worry about it. It's going to auto-calculate because you put all the information in the details right here, okay? Don't go down here and start messing with the premium payments. We're going to mess it all up. If you want to change the crediting strategies, you can do that. Right now, we have it set to 100% S&P 500, okay? But if you want to change it up, let's do 25% here, 25%. Let's do the Barclays at 25%. Let's do the Dow Jones at 25%. And I don't know, let's just do this one here, this annual point-to-point 140% at 25%, let's just say, right? So now we have 100% of our information here for index strategies. Again, don't touch the loans. If we add some extra riders, we have some additional riders you can put in here. Again, we're going to leave this alone for now. What we're going to do is the simple generic illustration that we see most agents run. Okay, so now we go back up to the top and we do view and print illustration. Okay, don't calculate results. That's not going to give you illustration. You want to view and print. Click on that. That's going to open up a new screen with the information. Okay, it's usually quicker. Let's see what's going on. There it is. All right, so here's our illustration. Can y'all see it? Do you see the illustration, Leo? Or no? No? Okay, hold on.
Maybe you need to stop the sharing, then share again. Yeah, oh, there you
go.
go.
I was only sharing my internet. Now I'll share my entire screen. Okay, so now you should see the illustration. Okay, here we go. Okay. And so now you'll see on the top here, zoom in a little bit so you can see better. Okay. So here's our client in California, the Freedom H40 non-tobacco at $300 a month. You get the face amount of $327,000, $772. That's face amount. We kept it at a level death benefit. I'll change it here in a minute to look at increasing. Okay, level death benefit. That means from day one, you get $327,000 of life insurance. I go here on the top, I go to our tabular detail, and this gives us information on the details of the policy, okay? So here we see in year one, she pays $300 a month, which is $3,600 a year. We always annualize the numbers. It's just easier to do an annual number. And you see here, she has immediate net death benefit, $327,000. And the policy, since it's set at a level death benefit, it continues at $327,000 for the entire policy time. Now, we said she was going to pay for 25 years, right? 25 years, $3,600 a year. And then at the end of 65, she starts receiving income. This calculated $11,520 a year of tax-free income. At this point, you will have $145,000 of cash value inside her policy. She passes away, she still gets $327,000. Now, as she starts taking money out via loans, those loans have to be paid back, and that benefit starts going down. Because none of those need to be repaid. Now, let's go back to illustration. We're going to change this one thing. Everything is still the same. We're going to change death benefit from being option A, which is level, to option B, which is increasing. Let's see how that changes our numbers. Go back up, view and print. There it is. This one here, same client, California, age 40, female, non-tobacco. We've changed it to option B, so now the death benefit is increasing. It hit the minimum. Minimum face amount on freedom is $150,000. So now she's paying $300 a month, which is $3,600 a year. Her death benefit now starts at $150,000. With accumulation and account value goes up to $152,000. So now you see here, we're adding the death benefit of $150,000 plus the account value here. $150,000 plus $2,737 is $152,737. And you can see it increases every single year. Every single year, she's getting more and more life insurance as the policy grows in value. Okay? So it's not much of a difference from an income perspective, right? The other one was what, 11,500, something like that. It was. This one was 10,774. Right? Yeah, 11,520 was the first one we did, and the second one here is 10,774. The difference is with level, we had a $327,000 death benefit from day one. She had more protection from day one. With increasing, she started at 150. She didn't get to 327. She actually didn't get to. She got to 326 right at age 65. So it took her 25 years to accumulate enough value in the policy when added to the life insurance to equal 326. So it just depends on what's important to your clients. Okay, is it important to have more protection from day one or more accumulation? It's really up to you and the client to make that determination. All right, and this one here, she has 176,000 of accumulated value with increasing versus here, she has 145. So a little bit more accumulation when it's increasing, but that benefit is a little bit lower. There's no right or wrong. It's just what's important to your client as to what's the best way to get protection. Final option, I'll finish with this one here, Leo. Death benefit option from B to A. So this one, what it does is, again, leaving everything the same, what it does is it increases over time, but at some point in the policy, we decide to make it death benefit to be level. What that does is it stops the policy cost from going up because you kind of end that death benefit from growing over time, and it helps maximize the income in the future. So in this situation, what most people do is they put it at age 65, right when they retire. So you can max out that protection over time, but when it's time to start receiving income from the policy, you stop that cost from increasing and try to maximize the income. So now let's go back up to view and print and see what that looks like. All right. So again, same client. Since we're doing increasing first at 150 and switching to level in year 25, we'll see what happens. So you'll see here, when we do that B to A, we will highlight that change in purple. So you'll see here at age 65, we have it highlighted, the death benefit, and gets frozen there. So the cost stopped increasing, now it's level, and you maximize the income. So you can see here, by doing that, now we potentially have more income at $14,622 compared to the 11,000, oops, that's the 10,774. So level one is 11,520, increasing is 10,774, and increasing to level is 14,622. So the potential for more income exists because now we've maximized the policy to its fullest potential. But something I want to make sure you're aware of, all you're showing your client here is an illustration, it's a proposal. If and when the client decides to choose this strategy, and this is what you present to them, and they want to level the policy in year 25, F&G will not do that automatically. You as the agent needs to remind them in 25 years to make that change, or the client has to remember to make that change in 25 years. Just be mindful, if you propose to do this strategy, it is not done automatically by F&G. It is something that you or the client has to initiate to maximize the return of the policy. But it's a great way to show the potential of this solution, okay? So as you can see, it's a pretty straightforward illustration process. You enter some simple parameters in the solve for right here, and you just play with the death benefit options if you want. You can play with the allocations of the indexing strategies. And if you want to add some extra riders, you're more than welcome to do that as well. But for the most part, 99% of the work is going to be done. Let me get there. Come on. It's going to be done right here in the solve for screen. And that's the easiest way to do that. And once the client agrees and you have all the information ready to go, you have their name, date of birth, everything is entered in email, you can go straight to reviewing e-signed illustration and start working on the application. Does that help answer some questions, Leo?
Oh my God, amazing. I learned a very big time again today. I mean, tonight, you know, with the different strategies that you just presented, it blows my mind because, you know, I know that a lot of us never did this kind of illustrations. I've been doing actually the B2A. I've been doing that a lot of times. A lot of my illustrations, a lot of my cases, I've been doing that. But the way you presented in comparison from A to B to the, you know, to the B to A is a very good illustration. And I know we have a lot of questions going on right now. I want to give the privilege to call on our founder for the Golden Stars to ask the first question. So take it away, James Lopez.
All right. Good evening, everyone. Thanks, Rodolfo, for taking your time. I know you're so busy with all the trainings and meetings.
Yes,
and it's our pleasure to have you here with us. And this is just, to let everyone know the FEG difference and the relationship we have with FNG is so different that I believe we're the only company that does product training hands-on directly from the back office, directly from the company. A lot of company does good in recruiting, a lot of recruiting, but knowledge-based. FEG does quality business because of the knowledge that we have. So let me ask the questions in behalf of everyone, and I think they're gonna ask all of it. So I'll have a lot of some questions for you, but since we're in the topic of illustrations, For the income stuff that she showed, I know the option A, option B, you have to remember that. But for the income, will that show on the actual policy when we deliver it, and will that automatically be applied for, especially the stop payment on a certain age? Will that be applied automatically, or the client or the agent has to do it on a certain year?
Great question. No, if you submit an application with that illustration from B to A, it's just a proposal. We will not make that change. The client or the agent has to initiate that change at that time. So unfortunately, it's just not something that we're able to do. So it is something that you will have to do as an agent or the client itself. So what I recommend, if that's something that a strategy you're going to do, when you deliver the policy, I would leave a note, right, or somewhere in on the top of the delivery requirements or on the actual policy itself. Remember, at age 65, call F&G to switch from B to A or from level to increase. It's just a little reminder note there, so hopefully they can remember at the time. But yes, it's something that unfortunately you or the client will have to take care of.
As far as the stop payment of the premium and withdrawal of income, would that automatically be reflected to on the policy and automatically be applied for, or something also that the agent has to do in their part to remind the client?
The latter. So the client is going to have to stop payment and then start requesting income. It's not something that's automatic. Because remember, just as a reminder, these illustrations are just proposals. They're just hypothetical examples of what could happen. We don't know. As soon as that policy goes in force and those indexing strategies start working for us, the illustration is going to change. We don't know what's going to happen in the markets, right? We don't know if the S&P is going to go up or down. We don't know if it's going to be, this or that. So it's just a proposal. So at some point when it's time to start receiving income, the client will have to call and say, I want to stop making payments and I'll start receiving income. And then that will happen at that time. So it has to be initiated by you or by the client. Mm-hmm. Mm-hmm.
All right. Next question. What's the reason behind the infant age is much more expensive than like toddler? I realized that if you do a 0-age baby policy versus, let's say, a 2 or 3-year-old policy, they have a cheaper pricing versus a 0-age baby.
You're saying that the older have is less expensive than the younger? Is that the question? Why?
The younger ones are much more expensive. Like the 0-age baby is much more expensive than a 2-year-old.
That's a great question. I think from an underwriting perspective, why that is. I mean, typically the younger
due to
you
a
are,
risk because of like sudden infant death? That's
a great question, James. I to be honest with you, I don't know. I'm going to find that out. I'm going to write that one down and get back to you, Leo, because that's interesting. You're saying that the younger age is more expensive than a little bit older.
It's just with the 0-age baby.
Okay,
and then,
0-age. Okay.
In terms of the illustration software, when it will be seamless, the illustration and the application, because I know we have to download manually, upload it in the application. Will we see that in the future, that it being seamless?
Yeah, we're working on that to make it more of a seamless process. That is one of our IT goals. I think this year or next, to kind of make that seamless process. But that's something I can pass along to our department that helps do that. So yeah, from illustration to application. Perfect. Yeah, that makes sense. I can see that. And I know some competitors do that as well. So I know what you're talking about with that.
All right, perfect. And then in terms of the claims and living benefit claims, I know F&G will allow partial claims or full claim. In terms of claims, if the client do an accelerated benefit claim, does the client still pay the premium for partial claim? Let's say they do a partial claim, there's something still left in the account. If something happens in the future, they can still access it, but does the client still pay the premium continuously based on what's left on the account, or does it stop?
No, you have to continue making premium payments. I mean, the policy is still in force. So we need to continue to receive premium payments to keep that policy going. That's a good question. If there's an acceleration, it's probably gonna be lower because now the death benefit has been lowered because you've used some of that money, but there will be still premium payments to be made to continue the policy.
All right, perfect. And then in terms of the option A of the policy, let's say the client took a policy loan on the account since it's an option A. If the client passed away, the beneficiary doesn't get the cash value, correct?
On option A, so you say if there's a loan feature and they take money out,
actually it's a two question.
You get what's left over. You get what's left over, because the loan needs to be paid back at some point. Okay, most people when they take a loan, they don't pay it back until it gets deducted from the death benefit upon death. Now, if you take a loan early in life, I mean, I used a loan a couple years ago to make a purchase. I was in my 30s when I did that. I want to try to pay that loan back because it's going to grow interest over time. But if I'm using it for retirement at age 65, I don't really care about that because I'm using it for income. And then that's when you see. I'm going to share my screen again real quick, if you don't mind, Leo. So you can I can show what we have here. If we go to share screen, we look at the illustration, you'll see here on the level, on the far right column, you see here 327 on the far right, and then you see in year 66 they take a loan of 11,520. Well, if they pass away that first year, the death benefit now is 315,676. The loan plus the interest that is charged. This is called the net death benefit. So you look at the top here, you'll see net. So it deducts it automatically from the policy. Okay. Now, to your point on the increasing, if you look at that increasing one here, this one goes up over time. Net death benefit there, right?
Yes.
It does not. It stays at 326.
So if it's increasing, it's not taken out from the death benefit, even you haven't paid the loan.
Right. As you go down.
Got it. And then if the client passed away on the option A, does the beneficiary get the cash value as well, or is just the net death benefit?
Just the net death benefit. Just net death benefit. Great question.
Wow, that is amazing. Thank you very much, James, for that wonderful questions. I know that a lot of us have also questions, some other questions. So in order for us to have a very good flow of the question and answer portion, I want to encourage everyone to either type your questions or raise your hand. So the first one online right now raising her hand is Miss Virginia De Vera. Virginia De Vera is actually one of the top earner of the Limitless Empire team who happens to submit and get paid up to annuities. Unfortunately, Rodolfo, that is for annuity. It's not for sale. The life, I mean, it's not for the life business. However, Miss Virginia also have a life business. It's a 1035 exchange. It's a big account. It's been there for more than 1 month. I know maybe this is some of her questions. So take it away, Miss Virginia.
2 months.
So,
hello.
2 months.
Can you hear me?
Yes, ma'am.
Yeah. It actually now is almost 2 months, but I've been trying to follow up on that. But my question is, I don't want to take your time on that particular issue. Mr. Siera, if in the case of a 1035 exchange with a cash value on the policy, how do we illustrate that when it comes to the illustration part? Because there's an extra money other than what you will pay as a premium. How do you reflect that on your illustration?
Oh, let me change my screen here. Let me share my screen. Okay. So on that here, if you want to do like a 1035 exchange, one of the easier ways to do it, when you go to your details you're solved for, okay? When you go to specify your premiums, instead of doing 300 a month here, like what's an example of a 1035? Like what's an amount that you put in there? Virginia, 10,000, 5,000? What amount would you put in there?
Miss Virginia.
Yeah, sorry.
Mute herself again.
Oh, we lost her, maybe of her internet connection.
That's okay. Let's just show. So let's just say you put, let's just say, was it 10,000, Leo? Is that a decent amount?
Okay.
Do 10,000, okay? And then I know it changed everything, but then you go to the second year, and now you change it to 3,600, because remember, we're doing now annual, right? Because we want to keep it annual. And then now you do it there. See that? So you put your premium amount that you're going to put in the first year with the 1035, and then the next year you can put the monthly premiums that you're going to be putting in, as an example, okay? You press OK, and you still have that 865 premium being paid to. You press OK. You go back to view and print. Computer. Getting tired, it's getting late. All right, so on this one here, there it is. 10,000 year one, and then $3,600 after that. And by putting that amount there, it changed the face amount. This initially was at 150,000, increasing to level, remember? Now by putting that more premium in year one, the system automatically adjusts the death benefit to maximize the accumulation within that. Okay? See, now death benefit is at 500,000.
I have a follow-up question on this, Rodolfo. What about if you put instead on the way you did it, there is an option on the illustration platform to put in the lump sum. Can we do that as well?
The lump sum.
There you
right
go.
Here?
Yes.
You can do that, but when I talked to my internal sales team, they showed me the best way to do it the way I just showed you. Just keeps it cleaner and easier, because it just auto calculates all on the same screen. This sometimes throws off the calculation a little bit. So my recommendation is going to the route I just showed you. It's just easier to go down the route, is what I was told.
Wow, that's amazing. This is again another brand new learning for me. I don't know with the rest, because what I've been doing is to put it on the lump sum, whatever is the estimated amount for the, because it says here the internal and external 1035 exchange. And I was thinking that was placed on the software for a reason. And since we're talking of a 1035 exchange, I definitely been doing this because it's how the software was presented, that there is an option to put a 1035 exchange money in either internal or external. Great. Wow, amazing. I love the learning.
It works both ways. I mean, because at the end of the day, again, remember, these are just proposals. They're all hypothetical presentations, right? They're illustrations. So nothing is tied to it. You're just showing what it could look like. At the end of the day, the application is what matters. When you do the application, you definitely want to put 1035 in that section to put the money's coming in. From an illustration proposal, this works just fine. I just was told the other one works just as good. It's just a little bit easier. How to go to different locations to enter your money, just easier from that perspective over there, is what I was told, from an illustration perspective. But good question.
Another follow-up question on this one, Rodolfo. Do you think that we will earn more commission doing the one that you showed us, or the one that we've been doing, putting it on a lump sum?
It doesn't matter where you put the money. All that matters is how the target premium is calculated. It's all based off the death benefit, so it doesn't really matter how you illustrate it. Again, it's all illustrations. It's all based on the targets, based on the on death benefit amount.
Wow, thank you very much. May I call on Miss Virginia if you still have a follow-up question on this?
Hello, hello. I'm so
Yes.
sorry. I really lost connection, and I feel so bad because that's the answer to my question, and I could not even see you guys. But anyway, another
Oh,
question that I would like to ask. I heard what you said, but couldn't see the screen. But anyway, if the premium or the lump sum that was carried forward to the new 1035 policy, and the
mhm.
client decided that in that same year she wanted to borrow from that cash that she had transferred, will that be possible at all? If
You
she
can always
borrows from
borrow
it?
money. You can always borrow money from a policy as long as there is value there. So yes,
Oh, okay.
in this example here, it's proposing again. We won't know until we actually do the policy, but
Mm-hmm.
based on the numbers here of the 10,000 that she puts in after
Mm-hmm.
paying the cost of insurance, some of the fees, the surrender fees. Right now, the account value is set at the 8,054. That's so she would have
Oh,
access to borrow that money. I wouldn't advise
okay.
that. Probably not a good strategy to do that. But if she really needed to for some reason, she'd be the money is there for her to access.
Okay. All
Hold on,
right.
Rodolfo. What amount that we're going to follow in if we want to borrow? Is it the account value, in this case 8,054, or the surrender value amount that is borrowable?
Oh, oh gosh. I remember the way they do it.
It's the surrendered value.
Yes, it's surrender value. I'm
It's
sorry.
from the
Yes, you're
surrendered
right.
value, Rodolfo.
Yeah,
Thank you.
yes, it's surrender value. Yeah.
Yeah, that's what I thought too. That's the reason why I raised that question, because you mentioned about the account value when we borrow the account value. But
Yeah.
I understand sometimes we have lapses, and you are excused for tonight. Thank you.
Yeah. It's all right. It's all right. It happened. Yeah. Brain fart. But yes, surrender
But
value.
thank
That's
you.
correct.
Thank you
Yes,
very
ma'am.
much,
My pleasure.
Mr. Shera. I appreciate. Thank
Pleasure.
you very much, Mr. Shera. I appreciate your time. Thank you.
Wow, wonderful. We're learning from the question. So I know we still have more we are still have time, I guess, because I requested for 2 hours. So take it away, Miss D. Kelly from San Diego, California, for your questions.
Actually, my question is, when do we use the calculate results button for doing the illustration,
Oh,
or do we not
yeah,
use?
I don't use it. I can click on it. You can kind of see. It just gives you some generic information. If it pops up. It just gives you kind of like a quick policy summary of some basic information. It's not a true illustration. It gives you the information you need, guys, to show the premiums and the potential income and definitely. But if you want an illustration to go over living benefits and all that stuff, I recommend doing the illustration. Just like a quick summary. That's all it is.
Okay, thank you, sir. Appreciate it.
Yes,
Yeah, I normally do the calculate results for a very it's an instant summary wherein you can present right away how much is the target premium, the minimum premium, the single guideline, some sort of that. That's the reason why I'm using that one as well. And if you are Rossi,
Also,
but if you want to do living benefits, it's good to use the illustration to kind of show the other benefits of the policy as well. That's why we usually like to do the view illustration. But yeah.
Also, Rodolfo, I'm not sure if you're aware. Sometimes that quick calculate too, or sometimes the illustration might be. There's times that if you solve for premium, like target premium, it will solve it. But when you check the details of the premium details, you will see the annual premium is not calculated the same as the target premium. So that's why sometimes the illustration will show below target. So that's why I tell my agents to double check, but make sure it's being calculated target. Because even you solve for premium for target, it still shows sometimes below target.
Yeah, we're gonna base it off of what we see in the illustration. So that's why I always recommend using the view and print, because that's what you'll be submitting and signing off on. This is gonna be the accurate information on the illustration. A good point, James.
I have also another question again, Mr. Shera. We know that we've been doing, like, we put the face amount, and there is an option there to have a lifetime. We have an option to add another rider, which is the term rider for the insured. If you can go all the way to the bottom, like for instance, you add this one for 150,000. You know, sometimes that's the normal amount that you can put. It cannot be lower than 150,000 in some cases, especially if your risk classification is a preferred non-tobacco. They won't allow you to go below 150,000 for the term rider. My question is, if we are claiming for living benefits, are we adding this term rider to be part also of the living benefits or the accelerated benefits?
Yeah, so the term rider for the for the primary insured, no, it's for the spouse has it. So great question. I'm gonna show you something real quick, Leo. I want you to share this with your team. There's a website that we have called synergy.fglife.com. I want you to write that down. Okay, synergy.fglife.com. I'll put it in the chat.
Synergy.
All right, I'll send it in the chat so everybody can see. Okay.
Great, thank you.
This is called, we call it a microsite. It's like a small website that we created that you have access to. There's no login required. It has information about their products you have access to, the Freedom and the Gold. You can go here, click on Freedom, and you'll be able to see the current interest rates. You'll be able to see the consumer brochure, which you can download. It has information about the product I can at a glance, so details about the questions you're asking. It has our underwriting guidelines, illustration tutorials, all right here at your fingertips. And if you go back to the home, you have information about products, some agent training, some sales concepts, some new business, all at your disposal. Brochures about the strategies, some life rates, anything and everything you would need. There you go. There's an illustration training, e-app tutorials, some product illustration, Freedom and Gold. There's some sales concepts ideas, and then some underwriting guidelines and help and stuff like that. So a great tool that you can use for agents only, so that you can get some information all available through this website here. So a great tool that you can use. So to go back and answer your question, let's just, I'm going to pick Freedom. We can go to the at a glance. Here it goes into all the details of the product, what the minimums are, the maximums, exam free, all the fees. So kind of, again, this is for agent only, right? For producer only use, not to be shared with the general public. Go through all the details there, and there's your riders. Okay, so your question is about the primary insured, correct?
Correct.
So this rider here has to be at least 150,000 from ages 18 to 45, and at least 100,000 from age 46 to 80. That's why you said depends, right? Well, it depends on the age.
Correct.
That's what it depends on, okay? It can do up to 9 times the base policy amount. So if you have 150,000 of death benefit, say the minimum, you can do up to 9 times that amount from a term life perspective, okay? It cannot, the term rider can provide additional coverage for a shorter period of time. It does not talk about living benefits on this. Thought it did.
So does it mean that since it don't talk about it, is it implied that it's not part of it, or is it considered that part of it? Because if it don't say something negative, then it has to be positive.
That is a possibility. They put all these little caveats. That's another follow-up for you, Leo. I'm going to check that out. I am not sure because it doesn't state it. To your point, if it doesn't state it, does it mean it's included? Or if it's not stated, it's not included. So let me find that out from a term life writer.
Another thing, Rodolfo, that I want to point out, because we have different companies that we have also chronic illness riders, and Like for instance, one of the best companies so far before, they have a chronic illness rider. Before in California, we don't have that chronic illness rider. And with the chronic illness rider with the other company, there is what we call the 90 days elimination period. However, with Fidelity and Guaranty, I'm glad to inform everyone, maybe some of you are not aware that there is no elimination period of 90 days. The moment you are qualified, you cannot perform 2 out of 6, automatically you can claim for the chronic illness rider. So that's also
That's
another good point for our product with Fidelity and Guaranty. That's why for me, I still consider Fidelity and Guaranty product as #1 that we should try first before other companies.
That's correct. That's correct. It's not, there's no elimination period. It's automatic. Yep, from day one. So, yep. And again, here's another living benefits brochure for more details about that. And this is, I believe is consumer approved. So this is a pretty cool little website here. You can kind of get all that information here to kind of look and see and play with it. It has all details for the Freedom and the Gold.
All right. Do you have any more questions? I'm giving 3 last questions before we end up our training for tonight. Who wants to raise the first out of 3 questions before we end up? Anybody? No more? So we're good. So I guess we are good. Thank you very much again. Thank you very much again. It's a wonderful night that we were able to have a chance. I know that your time is so precious, Mr. Siera, for especially you are in the in another time zones, and I really appreciate your patience with our team. And thank you very much for joining us and keep on helping us. I hope that we'll still have again another time. Maybe request that I can lock you in for at least once a month. Special training for our team. Is that possible?
I mean, possible. We'll talk, Leo, and we'll look at the schedules and see. I know we got convention coming up, right? In a couple of weeks. I hope everybody that's here on the call will join us in convention in a couple of weeks. I'm going to be there, so I'm looking forward to meeting you. So look for me. I'll be there with my team, and we'll be on stage presenting and talking about F&G and stuff like that. But yeah, I'm sure that we can find some time to do some training, and we can adapt and adjust based on what your needs are. So you can do a little bit different every single time and kind of show you some different things. So absolutely, we can work together, Leo, for sure. Be happy to help.
All right. Thank you very much. And again, in behalf of our team, thank you for that wonderful presentation. And I hope that we will have more time to learn more about the